why you should limit your currency pairs to only select few in order to be more profitable. That's the topic of today's video. There are a vast number of currency pairs you can trade, and depending on the broker, that number can go well into the hundreds of choices that you have. Of course, by having access to that many different currency pairs, you open up the possibility of having more trading opportunities. But is that really a smart move? I believe from personal experience that it isn't. In fact, it does the opposite. It's detrimental to your profitability. A much better approach is that you have a few select pairs that you trade, less than a handful, and you stick with those pairs and nothing else. And here's the reason why. There's a thing called volatility. Volatility is a degree of variation in price for a particular asset, be it stocks, futures, bonds, and in our case, be it currency pairs. So there are three types of volatility. There's low, there is medium or moderate, and then there is high. Low is small moves that are pretty stable, pretty even peasy, and don't move a lot, except unless there is an economic upheaval or breaking news of some sort. And you can trade those currency pairs with little or no drastic price moves much more accurately, and risk less because there is low volatility, and yet earn more profit. A good example of that is the EURUSD, which I have on the chart right here, and as you can tell just following the line, it has, of course, like every currency pair, goes up and down, but it's pretty much smooth sailing. It isn't your typical what you would see in a high volatile, which tends to go something like this, and then major swings. I mean, my drawing isn't good, like this, you know. If you are very much risk adverse, meaning that you can handle a lot of risk, then high volatility might be your ticket for currency pairs to trade. Personally, I don't do that. My currency pairs are all low to moderate or medium volatility, and you know, the higher the volatility, the more money you will risk. A good example of a currency pair that has only moderate or low volatility is the British Pound USD. And let me actually add it here so I can show you what this looks like. Where are the symbols? Let's see if I can have British Pound USD here somewhere. British Pound, it's not in this one. Bear with me for a second while I look this up. British Pound. Okay, of course I have to. Here we go. Okay, close it. There we go. I just added it. So now let me move that onto the chart, and you see this is moderate. Look at this overall view. It already told me I have an entry. I'm not going to take this. Look at this overall view right here versus the euro. I mean, the difference is very clear. This is what's considered low volatility. So this is what's considered moderate volatility. If you were to go to a high volatility, then you have the British Pound, Japanese Yen, for example, and you see the swings here are very, you know, they are, well, little, here we go, major up, we sidetrack or we consolidate, major down, consolidate, major up, consolidate, major up, Major down, that is high volatility. As I said, based on your risk tolerance, higher volatility may give you bigger profits, but you will also put more money at risk. And the reason for that is that each level of volatility has its own stop loss settings. Lower volatilities, or Euro USD in my case, has low stop levels. On a 1 hour chart, it is usually advisable to set it no more than 20 to 30 pips. But of course, that is only a recommendation. I still maintain that you set your stop loss at the most recent swing high for a buy and the most recent swing low for a sell position. But again, 20 to 30 pips is a very tight stop loss, and you risk a lot less money. And again, that is because there is little movement. There is slow, the currency pair is slow moving, low volatility. In moderate volatility, you would risk 30 to 50 pips as a recommended trailing stop setting. That is clearly more than the low volatility. And at the high volatility, they even tell you to put 100 pips. So it illustrates that the higher your volatility is, the bigger your stop loss needs to be from your entry point. The larger a stop loss you have, the more money you put at risk. It's a very simple concept. They're all connected together. So not only that, each currency pair, based on its volatility, prefers a certain time frame. For example, low and moderate currency pairs, low and moderate volatility currency pairs are good with the 1 hour and the 4 hour chart, while high volatility currency pairs are better traded on the 4 hour or even the daily chart to prevent these massive swings. And let me show you an example what I mean. Great British pound, Japanese yen is considered high volatility. So I move this here, and you see on the 1 hour chart how this just goes. On the 4 hour chart right here, it's a little smoother. And on the daily chart, let me blow this up a little, it's even smoother. So you see, that's the reason why. It's to kind of prevent volatility from making you lose sales. So, and losing profit basically. So it's important. It's important that you keep track of the volatility associated with the currency pair that you want to trade. Hence why it doesn't make any sense to try and trade as many different currency pairs as you can, because keeping track of each currency pair, on what time frame is best to trade it, what the volatility is of that currency pair, then add to that potential economic news or other global news that could affect price movement in a drastic way, and you're actually opening up the door to trouble. I mean, you're inviting it. So that's also the main reason why I only have 5 currency pairs, and I'm gonna get rid of this one right here because I don't trade it. But most of the time I'm in Euro USD, and I'll check towards the day if there's really nothing happening with Euro USD. I may check the yen, the CAD, the Aussie, and pound ninja, but that's about it. I rarely actually trade the pound ninja or the British pound, Japanese yen. So I'm just want to share with you, keep your currency pairs to a bare minimum. You can pick whatever pair you like, whatever pair you're comfortable with. You don't have to pick those that I recommend right here. That's my own personal preference. You pick whatever you like. If you're comfortable trading the USD, won, or Chinese currency, by all means, but then stick with that currency pair and learn how it moves. And you get that by practicing trades with that currency pair, open sell positions, closing sell positions, setting stop losses, take profits, and learn how it moves. Stick with that currency pair, and you'll develop something of like a sixth sense, almost intuitiveness, that you can just tell how the market feels, where it's going to, how it's moving, what potential you have for having a trade based on your strategy, and so forth and so on. So this is it for today. Just, yeah, pay attention to volatility. And I know you want to make a quick buck, but that's not what Forex trading is about. It is a slow, steady process that you repeat day in and day out, and you just go with the flow. You don't chase after the markets, which is basically what you're doing when you have a multitude of currency pairs you want to trade, because you're looking for a setup somewhere. So you're chasing after the markets. Don't do that. Let the market come to you. Limit yourself to just a handful or less of currency pairs that you want to trade. Stick to those currency pairs and learn how they move, how they react to news, how they react to economic upheaval, and you'll be well on your way to doing extremely well with Forex trading. It isn't difficult, it isn't hard, it's just a matter of learning the intricacies and applying them. And you can do that just as well as anybody else. All right, this is it for today. Take care. I'll see you in the next video. And as always, God bless.